Good morning, everybody. It's 10 o'clock, and we'll call a meeting to order. Item 2 is we got 2 presentations this morning, and Jake, you want to talk before we get started on that, sir?
This morning you have 2 of your non-equity fixed income managers in, Western Asset Management, which is a Core Plus fixed income mandate, and they'll be followed by PAMCO, and PAMCO is a lower volatility hedge fund to fund strategy. This is an area that's certainly of interest. They're just having these 2 managers in to give an update on the firm and what they're doing. It's been some time, and I'll just point you to the 3rd page of the ASAP report. Don't want to steal their thunder, but one of the things that we have tried to do in the portfolio is really diversify the implementation of the fixed income and making it more opportunistic, less sensitive to U.S. interest rates, particularly over concern really low rates and potentially rising rates. And you can see the benefit of that really coming out of 2008. The 5-year return of your overall fixed income composite, which is that gray line in the middle of the page, is 7.6% annualized, which is right around your required rate of return, versus a benchmark of U.S. investment-grade bonds, which has generated about 4.8% return. And much of that return has come from these 2 managers, Western and PAMCO on that side. So just with that backdrop, I'll turn it over to folks from Western.
Good morning.
Good morning.
About 30 minutes, so if you want us to do Q&A or however you want to do it, it's up to you. You just tell us how you want to do if anybody's got any questions, or you want to wait till the end, or whichever way.
Whatever works for you all. We're here for your benefit, so if you feel free to interrupt us during our presentation at any time if you have any questions. But it's great to be here. Glad I came to Oklahoma to escape some of the earthquakes in Southern California, so I'm really pleased about that. But luckily I'm trained in that department, so that's all right. My name is Frances Coombs. I'm a member of the Public Funds Client Service team at Western Asset. I've been with Western now for over 15 years. I'm joined by a colleague of mine, James So. He's a member of our product specialist team and oversees broad market portfolios in the core and core plus area, as well as long duration. So we're here to talk to you about what's going on at the firm, and more importantly, what's happening in the markets and in the portfolio. Maybe the best place to start would be to page 5 in terms of just a brief update on the organization itself. As Jason mentioned, we manage a core plus portfolio for the city. We've had the privilege of doing so since 2002, and I think that people in our industry don't say thank you enough, but I would just like to express the thanks on behalf of the firm for your support over these nearly 12 years. It's been an interesting time in the markets. We've seen a lot of historic things happen, and I think we really appreciate the support that you've shown us along the way. In terms of assets under management, total assets under management for the firm are approximately $450 billion, and that's across products ranging from U.S. Core Plus to global products that are managed overseas. The Core Plus team is headquartered out of our Pasadena office. Those portfolio managers work with the various sector heads located in Pasadena, as well as globally, to source ideas for the portfolio. And I think that's particularly important as portfolios are generally becoming more globalized. So it's great to have teams that are actually on the ground in really key market areas. Turning to the next page, you'll see an overview of the investment management team, and that team is led by Ken Leach. Ken has been with the firm for close to 25 years now, and he's now leading the team as the sole Chief Investment Officer after the retirement of Steve Walsh, who co-led the team effectively together for many, many years. And that transition actually happened over a one-year period, so it was very seamless. The team obviously knows Ken well, and clients have been very receptive to that, given Ken's history on the team. We had a new member of our team join in August on the mortgage-backed team. That was a gentleman by the name of Anup Agarwal, and he's a great addition to the team. So he's overseeing our mortgage-backed and asset-backed areas, a lot of enthusiasm, a lot of experience across mortgages, be it agency mortgages or non-agency, as well as commercial-backed mortgages. So he's been a great addition, and James will probably touch on a few of the strategies that we're doing in the commercial mortgage-backed area that have added returns to the portfolio. And lastly, we named a new co-head of our emerging markets desk. Well, he's not new to Western. He's been with Western for close to 4 years now. He heads up our Asia emerging markets team over in Singapore, but he'll be relocating to Pasadena to co-head the team with Keith Gardner, who's been with Western now for 22 years. Keith is going to be retiring in the next 2 years, so we're taking the time now to put that transition into place so that it happens again in a very thoughtful and orderly fashion. I think many of these transitions that have happened, certainly over the last 5 to 7 years, have been really aided by the underlying teams that we have had at Western Asset, the teams that have worked together in some cases for over a decade. So these transitions have been very smooth, and they haven't had any impact on how we're looking at bonds and our investment philosophy and process. Lastly, in terms of an organizational update, I wanted to let you all know that we recently settled an inquiry that the SEC and the Department of Labor were looking at for quite some time. So it's a long-standing issue that was very specific to ERISA-governed clients and specific to the parameters of ERISA law. So it was outside the scope of what we do for you all and for other public funds. You were not affected. We are pleased to have that issue behind us, and we respectfully agree to disagree with the SEC and the DOL, but I want to assure you that at no point did our philosophy or process or our focus in any way was changed or affected by these inquiries. So with that, if there are no other questions on the organization, I'll hand it over to James, and he'll go into the portfolios.
All right, just to reiterate what Fran said, we thank you for your support over the years. It's been quite a few years, I believe, since we've been here to talk to you about bonds. Would you like me to recap what the markets have done over the past year, couple years, our outlook? It's your time, so how can we best spend your time?
I think an overview of the philosophy for the strategy.
Okay.
And then how you're currently positioned and more outlook going forward.
Outlook going forward, okay. All right, so with that direction, I know it's been a few years, but as a rehash, our investment philosophy hasn't changed for the 40-plus years that we've been in existence. So we are governed by a few central tenets. The first one being that we are long-term, fundamental value investors. So those three things guide how we invest our portfolio, right? We're not day traders. You hear about all the high-frequency trading. You can't do that in the bond world anyway. The bid-ask spreads or the liquidity, right? What you'd have to pay versus what you could sell it at. It's much wider in bond space versus stocks. But we are long-term investors. We're trying to identify the long-term secular trends. We're not day trading your portfolio and churning it around. The next 2 points there being a fundamental value investor. The way I can emphasize that is when we look at the underlying fundamentals, and so to compare in the investment world, somebody that's a fundamentally based investor, right? We look at how the company's doing or how the country's doing or how, for a municipality, how the city or state is doing. We're not necessarily looking at the technicals of the marketplace. So there are technicians out there that will just look at charts and bands around trading patterns and things like that. We don't trade that way, right? We look at the underlying fundamentals, right? So we have a very, very deep credit team, a deep mortgage-backed team, which Fran mentioned we just added to a deep emerging markets team. We want to understand the company or the entity, right? But above and beyond understanding whether it's a good company, whether we should lend it money, whether we should lend it your capital that we're investing, we have to understand, are we being compensated for that? So we have to compare the valuations with the fundamentals. Right? Fundamentals could be great, could be a great company, but it might already be priced that way. Like, well, there's no point in buying it because there's no upside. So we're always comparing those two things. So we have to marry those three points: long-term, fundamental, value investing. That's our investment philosophy. The second bullet point really is we try to run diversified strategies in most of these portfolios because, you know, even the best investors are wrong a lot, right? So in our industry, we are trying to hit a bunch of singles, not swinging for the fence with any one particular strategy. So within your portfolio, if you look on page 13, you're going to see, I don't think I have to cover performance, right? You already covered performance. Yeah, okay, well, it helps that we outperformed over the past year, so I don't have to talk about that. But going forward, you can see on page 13, a whole lot of bullet points there. You know, I'll just emphasize that at the high level, this outlook comes from our broad market strategy committee. So we have a strategy committee that meets periodically. They determine the high level investment themes, the outlook for various economies, what we think various central banks around the world are going to be doing. And from that, the individual portfolio managers will take direction from that outlook, right, this outlook that you see here, and implement that in your particular portfolio, because everybody's portfolio is different. Right? You have a core portfolio with a certain benchmark. Some people might have a long duration portfolio. Some people might have an emerging market benchmark. So we have to understand what the outlook is and marry that with your particular guidelines and manage it in the spirit that you want us to manage it in. Okay? So our outlook, well, it's actually been a good thing that we haven't been here in quite a few years because it hasn't really changed all that much over the past few years. We do believe that growth is going to be kind of low and slow for some time. You know, it might improve a little bit, but in the U.S. here over the past few years, we've been telling people, you're going to get a positive GDP print. So numerically, it's going to look like growth, but it's not going to feel good. I know Oklahoma's a little bit different. You guys have, you know, booming energy industry here. For the rest of the country, a lot of the Taft-Hartley plans that we see, we tell people, yes, it's a positive number. It's just not going to feel good because jobs aren't there just yet, right? And so that's why we believe inflation is going to remain relatively benign for the foreseeable future, at least for the next few years. Now, there's a chart on this later which will show you that wage inflation hasn't taken off yet. So when we talk about inflation, and this will lead into what we think about rates, right? The long-term story of interest rates is tied to inflation. Because growth in developed countries doesn't move around all that much, you know, 1%, 2%, 3%, not that much, right? Inflation, you study the history, right? 60s, 70s, whoosh, go up, come back down. We've lived through the Great Moderation. But right now, for the foreseeable future, we see inflation kind of going sideways. And that's what the Fed is worried about right now. That's why they're keeping interest rates so low at the front end, right? They're trying to do everything they can. And there's not really much they can do, pushing on a string. But without seeing wage inflation take off, without seeing the jobs take off, then you don't get regular inflation. The definition of inflation is too much money chasing too few goods. Well, there's not enough money being out there, getting out there. Right? So no matter what the Fed is doing, the transmission mechanism is broken, right? The banks aren't lending money. People aren't borrowing. We got fiscal policy just mucking everything up right now. So that's our outlook. Given that outlook, as I said, those are the fundamentals that we see for the U.S. economy. Not great. I'm sure your equity managers will come in here and tell you things are great and equities are going to continue to go up quite a lot. We're the bond guys. We're always worried about what could go wrong. Because in bond world, you get paid your coupon. You know, that's how you win, right? You win by not losing. So we're always worried about what could go wrong. We don't see the next recession coming anytime soon either. We're not quite at that part of the cycle yet. But given this outlook and given where the valuations are, you see our strategy considerations down below. So down below there, you know, we're being kind of tactical with respect to, when we say duration, how sensitive we're making your portfolio to interest rates. Right? A lot of people are worried about interest rates rising. But as I said, interest rates will rise when growth takes off and when inflation takes off. We don't really see either taking off just yet, right? At least not nationally. So that's why you're going to see our portfolio being slightly more sensitive to interest rates than your benchmark index. And we use that as a hedge against volatility surprises, right? So that's the second bullet point that you see down there below. We're actually a little bit overweight duration, So we're more sensitive to interest rates. It's actually helped your portfolio this year as interest rates have come down. I think the consensus out there is to constantly be a little bit more optimistic than what the data shows you. Right? So there's this great book called Triumph of the Optimist, and the human spirit and human productivity and how it's always improving. Yes, yes, and yes. When we study some of the longer-term trends in the fundamentals, we're kind of in this middle period right now between the boomers and the millennials, right? If you believe demography is destiny. So the boomers are past their prime earning years, are starting to retire. The Gen X population, of which I'm a part of, we're a very, very small part of the population. Right? We're entering our prime earning and spending years. We have to wait till the millennials come in, and maybe then we'll see growth really take off. Maybe then fiscal policy will be a little bit different. But bringing it back to your portfolio, again, what you see is the third bullet point there, which is a continued theme within our portfolios. We are overweight financial institutions. So within the corporate sector, there's industrials, utilities, and financials. We're underweight electric utilities. We just think they have a lot of capital spending that they need to take on in the coming years, a lot of EPA requirements and whatnot. So their spreads are kind of tight. We don't necessarily like their valuations. Industrials, we're starting to see some bad behavior, not wholesale, but some M&A activity, some LBOs. They've healed their balance sheets since the Great Recession, and it might be getting a little restless right now, right? You have to do other things to continue to raise equity prices, so we're a little cautious on industrials. Banks, on the other hand, they still have the government looking over their shoulder. Lots of regulations, lots of compliance to deal with. They still can't really do that much with their balance sheets. They're making good loans right now. So if you were to ever come to our office and have our financials analyst present to you, he would start every presentation with a picture. And on this picture, on this slide, there's two pictures. One is of a utility meter, and one is of a slot machine. And his basic thesis is banks are going from casinos, the casino model, back to the utility model. Right? They're just becoming plain old banks again. And so from a valuation perspective, bank spreads or yields are giving you more than the other two sectors, which is why we're overweight banks. So we like it fundamentally. We like it from a valuation perspective. It matches up. That's why we're overweight banks. Okay. So that's one of the main themes within the portfolio. The other main theme, I'd say the fourth bullet point from the bottom there, we are maintaining an allocation to, these are mostly out of benchmark positions, non-agency mortgages. So during the crisis, these were called the toxic assets. Now they're called legacy assets. Euphemism, now that the government owns them, through Freddie and Fannie and whatnot. There's no new supply of these things. So here's where we kind of do pay attention to the technicals, the technical aspect of things, meaning supply and demand. There's no supply, a whole lot of demand, because given that the housing market is stable to slowly recovering, these bonds, you might not get back par, meaning you might not get back 100 cents on the dollar. But if it's priced at 80 cents on the dollar and you'll get back 95, that's a really good buy. Right, so again, we have to look at what are the fundamentals saying. The fundamentals say you're going to get back 95 cents on the dollar. But if we can buy it for 80 cents on the dollar, it's going to yield a lot more than a 10-year Treasury bond giving you, 270. Right. And then lastly, the thing that I would point out is we do have some opportunistic exposure to emerging market securities. They are in your index. The dollar-denominated bonds are actually in your benchmark index. So now that a lot of these countries have gotten upgraded recently, I'll just name off a few, like Brazil, Mexico, Panama, Peru, Colombia, Uruguay, Turkey, Philippines. They're all actually in the benchmark index nowadays. But we actually owned a little bit more than the index. We thought they were a good buy. That actually hurt your portfolio last year. So that was one of the big drawbacks to keeping your portfolio from outperforming the index even more last year. But long-term, being a long-term investor, long-term we still think these countries are going to do just fine. It's just that what they call the taper tantrum last year when the Feds first mentioned that they were going to taper interest rates, that was a risk-off move, and emerging markets, it's still classified as a somewhat risky sector, so that was a sector that took a beating. But long-term, we think it's cheaper. We added to your portfolios at the margin, and we think it's going to play out for you long-term. So that's, at a high level, I can go through a couple of market slides if you want, but if that would be helpful.
Question, please.
Yeah.
When you said inflation, were you talking about wage inflation or consumer purchasing inflation as being?
You can look at both. So you'll see wage inflation on page, let's see.
Reason that, because healthcare and food is just going through the ceiling.
Correct. So you'll see wage inflation on page 17. And when economists, when bond managers, when we talk about inflation, it's going to be a little different than when the consumer talks about inflation, because you're going to talk about what you're consuming, right? Obviously, healthcare, you mentioned, continues to increase, right? I'm going to have a few kids in college in a few years. I'm worried about that because educational inflation is going way, way up, even for the public schools, public universities in California. So that is one component of inflation. When you look at CPI, you mentioned CPI, Consumer Price Index, that's measuring how the prices of a fixed basket of goods changes from year to year. Fixed basket. Some of those things are going up, namely services. So service inflation is definitely rising, healthcare, education. Goods inflation, going way down. Right? How much does a TV cost today? And how much better is it than it was 20 years ago? Or a car, or whatever you purchased that was manufactured in China. An iPhone, right? This, $200, but it has a computing power of, probably 10, 20 IBM machines from 20 years ago. So inflation is the general rise in prices, and it's typically a monetary event. It's not one thing going up. It's not like we can say back in 2008, oil prices went up, right? Went to almost $150 a barrel. Okay, there was a rise in prices in that one part, but everything else was declining in prices. So the CPI really is only up about 1% to 2% a year. Healthcare inflation is probably up 6-7% a year. Everything else might actually be deflating. Right? When you want to worry about inflation, then we'll talk about Argentina or Zimbabwe. But yeah, without seeing on page 17, without seeing this actually take off, right? This is a structural necessity to see all prices take off. Is when people start getting paid more. Then you have too much money chasing too few goods. We don't have this just yet. Did that answer your question? Okay.
I'd be interested in knowing your opinion on how much unemployment and the participation rate impacts inflation going forward.
Quite a bit, quite a bit. You mentioned unemployment, so the headline number, what they call the U1 number, is officially 6.7%. But I wouldn't say nobody's paying attention to that. It's being somewhat dismissed, right? Because you might have a part-time job, but you don't want a part-time job, or you might have fallen out of the workforce. A lot of people talk about the participation rate, as you said. The participation rate has come way, way down. I'm sorry we didn't put the chart in here, but a couple of factors have led to that. So one, the demographic seismic shift that we're going through right now. Right? The boomers are moving through. We've had the kind of 50s, 60s, 70s, 80s, they called it the quiet revolution of women entering the workforce, and that's peaked and actually turning as well. Yeah, that's a neat chart to study. I think the St. Louis Fed has a whole bunch of charts on their website you can study. So those things are changing as well. And the next generation, the millennials or the Gen Ys that everybody's paying attention to right now, they are probably the most educated demographic force in the history of the U.S. However, they're coming into some very tough times. Right? Tough to get a job right now. They're coming out with a whole lot of student loan debt. You got people with college degrees taking part-time jobs at retail locations. So that all has to impact why we think growth is going to remain somewhat subdued. It's going to be positive. Yeah, we're growing. We're just not growing fast enough. Let's see if the...
Summary question. Certainly 2013 was a painful year for bonds. I think a lot of investors came into this year thinking, okay, well, what are we doing with our bonds? And then
For the next 12 months, so let's see, bonds are up about, let's say 2.5% already this year, right? Interest rates came down a little bit. You clipped a little bit of your coupon. We don't really expect rates to rise that much from here. The big move in rates came last year. And there's a chart on that earlier in the presentation, which you can see. As I said, given the long-term outlook, I'm sorry, not the long-term, but the short to medium-term outlook for inflation and growth, rates may rise a little bit from here. And so that'll subtract from your returns as rates rise, right? Bond prices fall. You'll get your coupon. So maybe for the next 12 months, you could clip coupon, which is about 3% in your portfolio. Not a whole lot given the environment we're in, right? So the Fed is engineering what we call financial repression. They're purposely keeping interest rates low. Right? They're punishing savers, but it's helping borrowers. You know, I just refinanced the mortgage. I mean, so it's great if you're a borrower, if you can get access to capital.
Gee, the banks don't want to cut loose the money.
No, they're being very, very cautious with how they lend.
How they're dealing with somebody.
Yeah, they're making good loans again.
Yeah,
That's why we like banks. You might not like them as an equity holder. Yeah. Well, we like banks as a bond holder, right? We care about two things, right? The ability of the entity to repay us and the willingness to repay us. It's like Russia defaulted back in 1998. They had a whole bunch of assets they could have sold, but they had no willingness to repay. But banks, they have the ability to repay again, right? They've rebuilt their capital. They're being very cautious with how they run their operations, partly because, you know, they got a regulator looking over their shoulders, but, yeah.
Any other questions board members have? Do you have anything else, sir?
No, I just, hopefully we can get you a nice 2.5 to 3%.
Right?
50%? Oh, there's ways to get yield. And risk is the other side of the coin. You cannot get return without risk. So what do you want your portfolio to do for you? Right? That's his job. We execute.
All right. Nobody has any questions? Thank you so much, guys.
All right, thank you for your time.
Good morning.
At least it's morning for us still.
There you go. Well, you got about 30 minutes, and however you want to take questions, we can wait till the end, or how you're...
This is your meeting. You can ask questions throughout the presentation, after the presentation, whatever you want to do is absolutely fine. We do have books for you. Do we have enough, Scott? Go ahead and start.
You're on.
Okay, wonderful. Well, first of all, thank you very much for having us here again. Really, I just want to thank you for your continued support and your loyalty for the last 8 years that we've been doing this, and we're really excited to give you some positive updates on the firm and on performance. And I'm going to steal a little bit of Scott's thunder here and to tell you that I know probably first thing on your mind is, what have you guys done for us? So the last year in 2013, we performed, your fund was up 13.5%. You can stand here. 13.5% net. And then quarter to date through March, obviously we've got the full year or full quarter, we're up about 280 basis points. So, but I'm not going to steal too much of Scott's thunder. I'm going to let him talk about, how we got there and what we've been doing at the firm to get you there. But first, let me just start with a quick reintroduction. I'm Dorothy Walsh, and I lead the client service for our commingled fund of funds, and specifically for the fund that you're in, Pacific Hedge Strategies. And I've been working with Jason closely and his group and with your firm for the last 8 years. I've been with the firm since inception.
Hi there. My name's Scott Warner. I'm a partner at the firm. I run our U.S. long-short equity strategy as well as equity market neutral, and happy to walk through performance, and please ask questions as we go.
So with that, since you have your books in front of you, I'm going to start to give you an update on the firms, really on page 7 and page 8. So the big story and the message that we want to give to you is that we do remain strong and stable firm. We have today about $10 billion of assets under management, and we have 135 employees across our 3 offices. Again, we're headquartered in Irvine. We have an office in Singapore and also in London. And really staying true to our business plan from the inception of the firm, we continue to develop our people and our partnership culture. One of the things that we've done is expanded partnership over time. Over the last 2 years, we've done that a couple of times and opened up the partnership to 7 additional employees. And Scott, I will say, is one of the, couple of years ago, was also promoted to partner of the firm. So we're proud of him. Today we have 18 active employee partners of the firm who make up the board of directors, and they're the ones that essentially control this firm. We do believe that doing the business this way really upholds our integrity and ensures the continuity and the longevity of our firm. So we're quite proud with that. But on the flip side of that is, as we continue to add partners, people do leave. So we did have 2 senior departures in 2013. Fondly, Bill Knight, who I love dearly, our beloved founder, one of the founders of the firm, retired just this last summer. So for me, it's a personal thing because I've been working with Bill for almost 20 years now, and he's been a great mentor to me, and I think Scott can say the same. He worked directly with him. So it's kind of happy to see him retire and enjoy his life now, but it's sad to see him not being there for us on the day-to-day. Also, Martin Netterloff, who headed our account management group and the portfolio solutions group, was with us for 4 years. He also departed at the end of 2013. So what we've done in anticipation of changes, which we always do, we don't want the firm to be dependent on 1 or 2 people. We did make transitions in some of the roles and responsibilities within the departments, and that has really gone very seamlessly. So we'll continue to do that. And, things change. So I think what I want to do is maybe highlight on page 8, I think it's really worth noting, is some of the remarkable people that we have at the firm that have really been recognized in the industry as leaders. So Jane Buchan, who's our CEO and also founder of the firm, and Lisa Friedman, who heads our research in London, were just recently named to the Hedge Fund Journal's 50 Leading Women in Hedge Funds. So we're quite proud of them for that. And then also Lisa was just named and appointed to the London Board of 100 Women in Hedge Funds. And then finally, Putri Pasquale, who was recently promoted earlier this year to partner, just authored a book on investing in credit hedge funds. And she's one of our credit hedge fund specialists. So they just happen to be women, but quite proud of them. And I think those are really the big things. Again, the organization remains strong, it's stable, we have longevity, we've got some really positive news, both on the investment side, and I think from this point, unless there are any questions, I'll hand it over to Scott.
You're on, Scott.
All right, perfect. If you guys need any help falling asleep, we can get you one of Putri's books. It's a thrilling read, if I must say so. So on slide 11, this is just a quick overview of the investment history, the size of your allocation with PAMCO, as well as the size of the commingled fund that your investment is in. Slide 12 is kind of where things start to get a little more exciting. So this is last 12-month performance from March of 13 through February of 14. Your portfolio up 12.6 versus the representative benchmark that we use, the HFRI Fund of Funds Composite. Certainly you can look at your return since inception. Year by year, we've had good outperformance versus that benchmark, and we'll touch on why we think that has been the case and why we, hopefully we'll continue to see that outperformance. If we go to slide 14, and talk about kind of 2013, the year that was, what worked, what didn't work, and then I can touch on some of our forward thinking in the new year. But basically, as we came into 2013, the House view and the view shared by many of our managers was that corporate risk was the place to be. We were largely out of global macro CTAs. Those aren't strategies that are represented hardly at all in the portfolio at the moment. Rather instead focusing on fundamental bottoms-up security selection strategies that focus on corporate risk. And corporate risk broadly defined, stocks, bonds, loans, and in certain situations, liquidation. So buying claims on the Lehman estate, as an example, was a very profitable allocation for the portfolio last year. Looking at some of the contributions to return, certainly leading the charge was our distressed debt sector. Distressed debt is a little bit of a misnomer given what's in that portfolio today. There are a fair amount of liquidation opportunities, so either Lehman claims or MF Global claims that are effectively where you can buy cash from the estate at a discount. And if you can understand the intricacies of the bankruptcy process, you can often get a very nice return on your investment as that cash is ultimately distributed to the holders of such claims. But the big driver in that book, and for a lot of the portfolio, was equity risk, in particular post-reorg or special situation equities. I'll highlight one example of that. In the distressed debt book, one of our managers had bought claims in bankruptcy of a regional broadcaster, so a company that had been over-levered, went through the bankruptcy process, went through the reorganization process. Our manager bought a stake in that company. Ultimately, it was converted into equity, and that company since then has reemerged from bankruptcy and has been a top performer. The stock more than doubled last year as the regional broadcasters have been able to renegotiate what are called retransmission rights and basically capture more market share or more of the value chain from the broadcast networks through these retransmission rights. So it's a story of a single stock and a single company that focuses on the types of opportunities that managers in distress are looking at today. So it's not typical. There's not a ton of bankruptcies at the moment. What we're finding are special situations or companies that are now emerging from bankruptcy, and that post-reorg equity was definitely a major contributor to the portfolio over 2013. Long-short equity, the sector that I'm responsible for the U.S. Portion of that portfolio, did quite well, both on an absolute return basis, but more importantly on an alpha generation basis. So I joke with my wife. She goes, "Oh, you must have been happy last year. The market was up so much." I go, "Actually, not really. I think the headline number of the S&P being up 32 kind of takes a little bit of the wind out of our sails because we delivered a heck of a lot of alpha. So that 18% return was on net exposure to the market of roughly 1/3. So if we're taking 1/3 of the market risk and we're just delivering beta, we would have expected to be up 8, 9, 10% perhaps. Instead, we're up 18 because of managers' ability to generate alpha and absolute return in addition to stock market risk. So we're really proud of the results that were delivered given the amount of risk we took to achieve those results. And ultimately, that's how we think about evaluating hedge fund managers. How much risk was taken to deliver a unit of return? And long-short equity, despite a very positive market during the year, they were able to generate alpha on both longs and shorts in what became a pretty good market for stock picking. And that dovetails into our expectations going forward. What we see in equity markets is a lot more dispersion in stock price performance. Winners and losers are being rewarded on the merits of their underlying business. Even today, you can see there's a good mix of positive and negative occurrences in the market that are being driven by what's happening. You know, eBay's up this morning because they decided to settle their proxy contest, stocks up. That's a good environment for picking winners and picking losers. Best Buy had a weak Q4 earnings outlook. Stock was down. And your ability to take a fundamental view on what's going on at each individual business and profit from that view is a dynamic that is a welcome sign. Post-08, the market kind of every stock traded together and was dependent on what the Fed was going to do, what the ECB was going to do. Now, the merits of each individual business is being more rewarded in a way that we haven't seen in years past. We certainly saw that trend begin to emerge in 2013, and we expect it to continue to do so in 2014. Long-short credit, another contributor. I will say, oh, sure.
Because you talked about the long-short equity and it is a component.
Yep.
We've had this discussion with you guys
Yeah.
in the past. This strategy within the asset allocation is a fixed income surrogate. They have other long-short equity. And you touched on this. This long-short equity component that you have here is always going to be fairly low net exposure compared to other more directional
Yep.
hedge fund strategies.
Yep. Yep. So yeah, that's a great point. So the goal of this portfolio is to generate absolute returns. One of the strategies we use to do that is long-short equity. That said, we don't want the portfolio to have a meaningful amount of beta. So what you'll see is a lot of other offsetting exposures in other strategies to keep the market beta of the portfolio rather low. So we saw that in January of this year. The S&P was down 3.5%, and we were up. I think the portfolio is doing what it should do. We are taking equity risk, but not highly directional equity risk. So I like to say we're making bets on specific companies, but not the market. I think that's the right way to think about how long-short equity fits in the context of the overall portfolio. Moving over to long-short credit, one of the things we don't like right now, actually, is credit. So we have very low exposure to high-yield bonds. We have some loan exposure. We have some liquidation exposure that's bond-like in its return stream. But generally speaking, we find high yield to be fairly unattractive. Spread absolute return potential there we think is quite low. The risk is quite high. It's an exposure that we really backed up the truck on in 2009. And as we sit here today in 2014, that's really transitioned quite a lot. So while you don't necessarily see our strategy allocation move that much, the underlying components and underlying investments of our managers looks a heck of a lot different today than it did 5 years ago. One of the things is certainly I have to highlight things that didn't work. Our opportunistic strategy is meant to be a little more defensive, meant to bring us different types of risk in the context of an overall portfolio. Having a strategy down last year, obviously you never want anything to be down, but it does serve its purpose. It's supposed to be different. It's supposed to be unique, supposed to capture other types of risk than is represented elsewhere in the portfolio. And our convertible bond hedging strategy didn't return all that, was positive, but not outstandingly so. And I will even say that strategy name is also a misnomer as we sit here today. Back in 2009, coming out of the crisis, convertible bonds in that market was highly dysfunctional, had kind of blown up in 2008. It was easy pickings. As we sit here today, those spreads have collapsed, and our book looks very different today than it did in 2009, with very little exposure to traditional convert ARB as a strategy. Let me pause there and see if there's any questions. If not, maybe I can get you to move ahead to slide 16. And this is a bit of a complicated slide, and one that took us a while to get our compliance department to sign off on. So they finally allowed us to sneak in a small chart here amongst all the disclaimers. But it's a powerful one, and if you let me kind of walk you through it, I think it is a testament to how PAMCO invests and why we think we have a strategic advantage in how we source managers and how we work with managers. So going from left to right, the hedge fund return, we'll call that the benchmark index, was up, and this is over the last 2 years, 12 and 13. That was up on an annualized basis, 674. Now, if PAMCO was just a plain vanilla fund of funds, if the only tools we had were to pick managers and allocate to strategies, we would have been up 825 over that same time horizon. That is kind of what I call the old school way of fund investing, is we just give our money to managers, put it in their funds, and let them do what they do. I think PAMCO is very good at sourcing managers and has been good at strategy allocation, and we see that evidenced by 151 basis points of outperformance versus our benchmark. That said, in the world we live in 2014, increasingly more and more of our assets, PAMCO is retaining ownership and control. We're negotiating how we work with managers much more aggressively today than we have ever been able to in the past. Part of the reason is fund flows into hedge funds have kind of dried up for smaller funds. A lot of the flows have gone to the mega $10 billion funds, but the $500 fund has not gained as much traction. When we come in and are able to negotiate using our size and scale to negotiate on fees, that flows directly to the bottom line for our clients. So if we go from bar 2 to bar 3, moving left to right again, we've added an additional 189 basis points through the way that we work with managers. So that could be negotiating on fees, that could be through customizations, that could be through tactical trades with the manager, changes of leverage, a lot what I call a high-intensity approach to investing with managers. And I think the world as we see it is that if we can add a basis point here, a basis point there by negotiating with managers or structuring things or better than we had in the past or being a little more tactical, that adds value on average and over time. And if we can do a basis point here and a basis point there, collectively that can add up to a meaningful number.
Can I just add something here, Scott? What's important to realize here is that we're not telling the managers what to do. It's really a team effort with these managers, and they have ideas. So we're not changing what we're doing on our side, on the investment side, but it's how we're working with these managers to get these enhanced returns.
Yeah, so an example of that even last month was we had a merger arbitrage manager who we have a high degree of confidence in and has been in the portfolio for a number of years. Merger arb spreads blew out during the month for no fundamental reason other than people were getting a little jittery on the market and money came out. These spreads opened up and we thought the return potential had increased. The manager calls us and says, look, the opportunity set just got a lot better. I think you should put more money to work or to lever up the account a little bit. So that was something mid-month that we were tactically able to take advantage of an opportunity because this manager invests in a PAMCO-only structure. So increasingly, I think we're thinking about how we structure investments to extract more alpha from each manager relationship. And in a world where zero interest rate policy is pervasive on a global basis, each basis point counts. And so we're certainly proud of that additional value we've been able to add in and above just picking good managers and picking good strategies. Does that sort of make sense, hopefully? On slide 18, here's kind of the sector allocation as we sit here today. Long-short equity, long-short credit remain kind of the dominant strategies. We don't see any change in risk profile that would cause us to dramatically alter our strategy allocation. We continue to be constructive on corporate credit, corporate risk broadly. One thing that we have looked to add is additional managers focused on special situations, liquidations, and alternatives to traditional high-yield credit. I mentioned before we generally find that unattractive, and we're making sure the portfolio reflects that view. But generally speaking, we're not expecting any dramatic sector shifts. At the moment, we think it's still a very good time for security selection, and that, given our bias towards fundamentally oriented strategies, should be a very good environment for us. So let me pause there. Hopefully that gives you a bit of an update of kind of what we did in 2013 and how we're positioned on a go-forward basis.
Any questions? You're on, sir.
All right. Whoops. That was easy. That was much better than going to the dentist.
Much better than going to the dentist. All right, Scott.
Thank you all very much. We appreciate the opportunity to continue to serve you.
Thank you, guys. Okay, item 3 on the agenda is approve the minutes of the meeting of March 13th. Motion been made. Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 4 is received. There's 4 reports. Motion been made, or there a second? Second. All those in favor signify by aye. Aye. You have a question? Yes, sir?
Is this one where the claims docket is?
Yes, 6 is claims docket. Okay, item 5, they're ratify the approval. There's 4 items, or 5 items, rather. Motion been made. Second. All those in favor signify by aye. Aye. Opposed, same sign. Ayes have it. Item 6 is approve the claims docket. Ken, you have a question?
Yes, the Davis Ham Stubbsville. Is that our law firm?
Yes.
This is the initial filing for our determination letter. It was a large filing. This was the work with the Internal Revenue Service. They've met with the agents. We did a few rewrites through our office here and coordinated with Wiley. So it was just a rush to get it done, to get it filed before some actual changes took effect in December 31st. And so it was, all amendments had to be updated at that point and submitted. So everything has been done, and we have submitted everything to the Internal Revenue Service, and we're on process for the determination letter.
Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 7 is their application for service retirement, and there's 1, 2, 3, 4, 5, 6 of them, looks like. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 8 is receive the report of death and authorize the payment of $5,000 death benefit, and authorize the Secretary to make necessary changes to conform to the following, and there are 3 items. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 9 is also receive the report of death and authorize the Secretary to make the necessary changes to conform to the following, and there's 2 of them. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 10 is approve the following application for vested rights. And they are, motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 11 is approve the request for the following to terminate vested rights and commence drawing retirement benefits, and there are 2 of those. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 12 is the investment consultant's report. Jason, you are on, sir.
I don't have much after the 2 managers presented. Just in terms of going forward, we had talked at the beginning of the year to continue to build out the real asset portfolio, starting with or beginning with commodities. We intend to come back next month with candidates, just information on probably 5 candidates for your consideration, and then interview at the following meeting in June. Unless, I forget if there was something in June. Okay, I wasn't sure if there was a hearing or something. Okay. So we were going to bring information in May and interview in June. So that's, when you look at the asset allocation and see equities are over-allocated, it's because the real assets are under-allocated.
Right.
So far, for the year, markets have essentially been flat. You heard from Western and PAMCO, your fixed income has actually been your best performing area of your portfolio for the year, as interest rates have come down. Bond prices have gone up a little, and that's been a positive. And then the other thing that we've seen is international, at least through mid-April now, is international markets have done a little bit better than the U.S., and small cap has sold off a little bit more, which is not surprising, as small cap stocks had really run up the last several years, and from a valuation standpoint, we felt that they were a little rich. So now on a 1-year basis, the portfolio, The year ending March 31 is up 12.7%, about 70 basis points ahead of the policy index, but well ahead of your required return. More importantly, that 5-year number now, you've generated a 13.5% per year return over the last 5 years coming out of that 2008. So markets have done well, but that's helped to build up a little bit of a premium to that required return, all while keeping risk fairly low. No other manager issues to talk about at this time. I think the plan as we go forward, once we get through the commodity discussion, we will want to continue to bring in some current managers just to provide updates. In my notes here, I have that we'll, in August, bring in your small cap managers, and then probably in November or in the fall, bring in K2, the long-short equity manager, and perhaps real estate managers at that time as well. Kind of time just to revisit and just get updates from the managers, not that there's issues. But.
Okay. Anybody got any questions? Board members have no questions? All right, thank you, sir.
All right, thank you.
Item 13 is comments from board, staff, or citizens. Any board members who have anything? We have one election coming up, correct? Paul's election, okay. Yeah, okay. If no questions, then at item 14, we will adjourn at 10:57. Thank you all so much.